Let us start the topic today on options trading. So we will start options trading. Options trading. So where these things are getting applicable. Okay. Okay. First we will do in equity markets. Then we will start with what you can say indices, equity indices. Okay. This is options trading in India market. Okay. Then we will study on US market, India markets. Okay, hopefully it is clear. Equity indices. So what does equity indices it comprises of? And we'll study what options is all about. Okay. So we will study first stock indices. We will not do stock. Okay. We will directly go with index. Nifty index because it is indices. Nifty index. And then there is Bank Nifty Index. We are only studying options, not futures. It's only options trading. Okay. It is respective to India and US market also you can see. US markets. We'll go in single slide. Okay. We have equity index, Nifty index, Bank Nifty index. These are the major traded index in the stock markets. Okay. Similarly, if we go, this is in India. If I go, it is India market. Now coming to one more chart. Okay. US market. Again, it go with equity indices. Okay. So it is again divided into three major components. Here we will study later. Here we will say Dow Jones Index. Dow Jones. Then we have what you can say NASDAQ Index is QQQ. And this is Dow Jones is US 30 stocks. And then Russell 2000. Russell 2000 index. These are called small cap index. Okay. So when we talk about Nifty index, there are 50 companies. And Bank Nifty index comprises of 12 banks. Okay. So what is options trading? So when we talk about options trading, it is applicable to both US and India. Okay. So we have one called CE. This is called call option. And then we have called PE. This is called put option. So irrespective of you trade in India market or in US market, the call option and the put option, the terminology remains same. Okay. So what is call option and put option? Call option means you expect the market price to go up, so you buy a call option. Buy a call option. Always market is up. This is the market. You expect the market to go up, buy a call option. You expect the market to go down, buy a put option. So this kind of, whenever you are taking any kind of call or any kind of put, it is applicable to both US market and India markets. Okay. So call option is just, you assume that the market is going to make huge jump, take a call option. This is just simply the basics, but there are a lot of complications. But for the timing to quickly start the trading, you have to take either a call option or a put option. Okay. So when to take a call and when to take a put, that is, I'm just explaining it. So you expect the market to go higher, you buy a call option. You expect the market to go down, take a put option. If market values your ideology and thinking, then only you can make money, otherwise you are going to lose money. Okay. So now coming to this options in India. So right, currently the Nifty is trading at, let's say, 26,000 200. Okay, and Bank Nifty is trading at, say it is trading at 60,000. Okay, you expect when you will take the call option. So we will be having the call option of Nifty, call option of 2600, 26200, 26300, 400, 26500. Similarly, you will be having the put option as well. Put option of 26100, 26200, 26300, 400 and 26500. Okay. So every you can get 5 points up, 5 points down as well. You can get 25,700, 800, 600 call and put of both the trades. Similarly, Bank Nifty will be having the call option of 60k, 6100, 6200, 6300 and so on. Similarly, put option of 60,000, 6100, 6200, 6300. So when you get to see this, so you will be having below 5 and above 5, means the call option can be plus 100, plus 200, plus 300, plus 400, plus 500. Okay. Similarly, the Bank Nifty will be having plus 100, plus 200. Similarly, you can get the Bank Nifty put options of 26, 800, 700. Once you log in into the trading terminal, you can get both call and put. Okay. So now coming to call and put. So like I say, the currently Nifty trades at 26,200. Okay. So we have three concepts. One is called in the money. Okay. That means call is in the money, out of the money, and at the money. At the money. So there are three concepts. So like Nifty 26,200 is the current base price running in the market. Okay. So when we can call the out of the money. So let's say you take far away from this, like 26,500. So that is far away from 26,200. So this is called out of the money. So if you take like 26,300, you expect the 100 points to move it up. That is called at the money. Okay. Now let's say 26,200. That is called in the money. So the call option will, whenever the prices goes up, okay, 26,200 is the base. If it goes to 100 and it goes to 500, you makes the money. But when it comes near to the expiry, this will go zero. So in a plain understanding, always try to make the money in at the money, and out of the money you will make the money when it crosses. Let's say 26,200 is there, and you expect the market to go above like 26,600. Then the 500 will become again at the money, and you will make 100 points over here. So here you make 100 points. So out of the money will only give you money when the call prices, when the base, right, underlying base makes a huge jump. Huge jump. Okay, so I always prefer at the money and in the money. I mean, you to make money in intraday. So out of the money is just like a lottery ticket. Like sometimes what happens, 1 rupee goes to 50 rupees. Sorry, 1 rupees goes to 50 rupees, and then 50 rupees becomes 0 by the end of the day. So it will happen during the day, and it will close during the day. That means at any point of time the market will go up. Like this 1 rupee become 50 rupees means if you have invested like 1 lakh, it will become into 50x, 50 into 1 lakh. So that is what we call as 50 lakhs. You can make it 50. That is an improbable task, but people, I mean, very rare people will make. So that time, let's say the price of the Nifty is 1 rupee, and you buy in bulk. Okay. So this is a rare scenario where we will talk about in the money, out of the money, and at the money. So in the money is near to the base price, at the money is 100 points down and out of the money is far away from the market price. So I hope you got the concept of in the money, at the money and out of the money. So out of the money only will make money when it goes in your favor. So call option is you are expecting the market to go up, put is you are expecting the market to go down. Similarly, everything is applicable to NASDAQ, Dow Jones and Russell 2000. So whatever the call option, put option, let's say Dow Jones US market is Dow Jones US 30 is currently trading at, for example, 48,500. Okay, and NASDAQ QQQ is trading at for example 6,000. Okay, you can see in the market price, and Russell 2000 is trading at like somewhere around 2,300. Okay, so these are the similar kind of values what Nifty and Bank Nifty is currently trading. Similarly, US is having this. Since we are trading only in options trading, when we go about futures, we will talk about futures. So whenever you try to talk about futures, I mean call options and put options, so these are the things being applicable to here in the same similar market. US 30, Dow Jones 30 options, NASDAQ QQQ, that is also we have options 30. We have multiple companies over there, and Russell 2000 is all small listed companies. Okay. So call and put, whenever people talk about options, where do you trade options? Index and Bank Nifty Index and Bank Nifty Index. So similarly, we have in US market the corresponding things are there. So this is, we talked about call, put, in the money, at the money and out of the money. Okay. So these are based on equity indices. People can trade in stock indices as well. So but for the timing, I have spoken about equity index. Okay. I hope the basics are very clear to you. So before jumping on directly to the trade, so those who doesn't know anything, don't go directly jump it. See the nitty-gritty and integrity of this call and put have people bankrupt many a times. So be careful while trading options. Okay, this is just my understanding or thinking towards options. So you take trade as per your own risk. I am just explaining the theory how options derivative market is working. So this what we call as the derivative trading. So this is called derivative trading in India. In US as well, derivative trading. So derivative trading is nothing but based on the cash price, the future takes the moment. So like in if we say what you can say, the base price of Nifty is currently, let's say we talked about 26,200. So this is the cash value. Okay. Let's say Nifty futures. Nifty futures is having a point of 26,300. So this is derived from this. So you are a 100 point plus. So whenever you take that points and Nifty goes up, your price value also goes up. Price of the options, price up in the option. This price value will definitely go up. So when we go practically, I will show you how actually it works. Okay. So I hope this is clear in options trading. What are the things? Indices, Nifty Index and Bank Nifty Index. We have small cap, we have what you can say, Sensex. We have so many indices in the markets, but currently we'll focus on Nifty Index and Bank Nifty Index. Okay. Now coming to the what you can say, we have different kind of expiries also. We'll teach. Okay. Sorry for this. So now comes directly to the topic. We will jump on. Let me allow me some moment. Allow me a moment. The problem is the network at home sometimes doesn't pick up. Sorry guys. Sorry. So before going to this, I am going to talk about few things. Uh, so what are the indices? So when we talk about indices, I will show you the what are the indices we are having it. So which I talked about, the major two indices are Nifty and Bank Nifty Index. Okay. So whenever the options trading happens, the majority of the volumes occurs in Nifty and Bank Nifty Index, which is this. This one, just to reiterate. Now coming to options trading, we are still continuing with options trading in Indian and US market. Now we talked about equity indices. Now we will talk about commodity indices. Commodity indices. Commodity indices in options. Okay. So what are the commodity indices? One is, the first is crude oil. Second is natural gas. These are the major traded elements in India markets. Third is copper. Fourth is aluminium. Fifth is copper, aluminium, nickel. Okay. We have the major commodity indices, what you can say, gold. These are the major indices. Gold. 7. Silver. Okay. What else? Natural gas, crude oil, copper, aluminium, nickel. So many gold indices. Now we have what you can say commodity indices in options. So when I talk about commodity in Nifty, we have given indices, right? So currently the base price of these indices. So the base price of the crude oil currently trading at, like, let's say if you open 5,600, natural gas somewhere around like 300 or 250 somewhere around, copper like let me open, I mean I don't remember actually. Sorry guys, I'm using Market Pulse. There are so many applications which you can study and learn. Oh, the network is the culprit here. I have to go there and once again. Why is the network at home? Sorry guys, I got it. I mean, I will just show you. That is what we call as commodity indices. Commodity indices means MCX. It is an MCX exchange. Okay. So you can see the gold is now trading at 1,38,000 in February series. Let's say gold is now trading at 1,38,875. Okay. Now silver is trading at 2,52,000. My goodness. 2,52,200. Okay. Where is that? Copper, aluminum and nickel. And we have another entity called zinc as well. Okay. Zinc is now trading at what you can say 309 rupees. Nickel is now trading, crude oil is 5,300. Oh my god, there is a huge dip. 5,300. Natural gas, I will show you. Natural gas is now trading at 293 rupees, 300 almost. Okay. Then now comes copper. Okay, copper is trading at 1281, too high. Aluminium, let us check. Aluminium is trading at 317 and nickel is trading at nickel is trading at 1705. Okay, so this is called bullion markets. I mean mostly MCX, the what we call is in the commodity. So the commodity trading, the current base price is this. So how you can trade this kind of options? Okay, so these are basically, when I talk about 5,300, these are the current market values of this kind of commodities. So what you want to take a trade? So if you want to take a trade in here, okay, so like let's say for example crude oil, I'll open crude oil contract. Okay, so I'm just teaching out how you can trade in options. Okay, so now coming to the crude oil. Okay, so crude oil, the contract is 5,300. So you will get 5 points down, 5 points up. Like you will get 4,800, 4,900, 5,000, 5,100, 5,200, 5,300. I am taking what you can say 5 points down and 5 points up. 5,400, 5,500, 5,600, 5,700, 5,800. Okay, so this you will be having one call and put. Similarly, this will be having call and a put. Here I am just once again explaining how in the money, at the money and out of the money will make you money. Okay, so here also call and a put. So 5 call and a put. So 5,200 is also having a call and a put. 5,300, 400 C, P. I'm just giving an example. Okay, similarly you can trade for all the other commodities. So this is just the basic example. So you learn one, you will learn everything. C and P. You will get all the values of C and P and I will show you in the live session. Okay. So like 500 to 5,300 is our current base value. Okay. So this value, if you take the 5,300, right? So this is the current market price. Okay. So current market price will be having some kind of call and a put. Sorry. Okay, let me add how you can add it. I am just showing it. Crude oil, I will just show you all the values. 4800 Jan series, you see. C and P, you see everything. Crude oil 4,800 CP will come. Okay, 4,800 C and P value. Okay, now we will go with the C and P. What is the C value? Currently trading 509 rupees. 509. And what is the P value? It is 4 rupees 60 paisa. Similarly, we will go with 4,900. 4,900. You see, got C and P. Get 453 rupees slash, what is the P value? 6 rupees. Okay. Similarly, I am calculating 5,000. I'll just show you one example. You can study the rest. 5,000. 5,000 CEP. It is 365. 5,000 P. It is 98. Okay. Now comes 5,100. 274 slash P. 5,100. 22 rupees. Now what is the current market price? Which is 5,300, which is trading at 5,000. This is 131 rupees. Call, and what is the put? 5,300 P. 80 rupees. 80 rupees. Now this, if we go towards this is what we call as, and if it is in the middle, that is what we call at the money, and if you are going towards this is called out of the money. OTM, when we call as ATM, this is called in the money. ITM, ATM and OTM. If the market goes aggressively up, let's say current market price is 5,300, if it goes towards this, take the call option. If the market goes down, take the put options. Okay. Now coming to 5,400. 5,400 is 87 rupees 50 paisa. Okay. 5,400. 5500 is 57 rupees. Then 5,600. 5,600 call is 3750. I am just explaining in a very slow manner. Okay. Then 5,700. 26 rupees. And then we have 5,800. 19 rupees. So these are call value. Now we will go for the put values. So put value is what you can say, 5,800. That is 355. Okay, why the put value is higher? Because the market is going down. So whenever market goes up, take the call value. Whenever the market goes up, take the call value. Whenever the market goes down, take the put value, P. Okay, 57,500, that is 379. Now comes 5,600. 286. 5,600. Then we have 5,500. 204. Okay. Then we have 5,400. Put. This is 134. Okay. Now let me open the chart and I will explain you how and when you can make the money. So this is the crude oil. Now coming to this is the January series. Okay. So now let me open the chart. Strategies, when to take the call and when to take the put, I will show in my next session. Okay. So you see that this is a January series future, right? So this is a 15 minutes candle. So whenever now the market is trending a trade around like 5,300, right? I think I will show you in the bigger board maybe from the next class. So like you see, right, when I talked about 5300, okay, so like 5300 is in the money, at the money and out of the money. Now the market trades at like 5300. Okay, 5300. If the market has to go up, let's say you see in the next 2 days, you want to go, the market go up, buy this call option 540055, buy this call option, in the money, out of the money. You expect then these prices, right, option prices will shoot up and these prices will go down. Now why these prices are going down, going up, the put prices? Because in the last few days, right, market has let's say if you go by day wise, market has drastically reduced. Okay, it has reduced from 5300, 5400 to 5000, almost 300 points down. So whenever the market goes down, the put value increases, call value decreases, right? You see the call value is getting decreased. So always try to predict the market. How we are going to make the prediction, that I will show you in the next session, when to take a call and when to take a put. So you understand, right, the base prices, how these prices are being up, because you see 4800, 4900, 5000, 5200, these are getting decreased because market is going down and the call values are getting, put values are getting increased. 4.66, 98, what you can say, 98, 22 and 80, 122. You see, it increased, it increased, it increased, it increased, it increased. So whenever the market goes down, take always buy the put option. When the market goes up, if the market goes up, then this value will go up increasing. 5200, 5100, 4000, this will go on increasing. So always ensure. So how to predict the market, we will take up in the next session. So you understand. So this is applicable while trading in natural gas. Similarly, natural gas, you take like 290, 280, 270 call and put, and check like 300, 310, 320, 330, you will be having the call and put prices. Copper also you will get 1280, like 1250, 1270, 1280. Take 10 plus up, 10 plus down. In the gold also, gold, silver, those things also, I mean, you can also trade like 250, 2,52,000 is there. You can take for 240, 280, 270, 260k. Like here also 150k, 140k, 130k, 120k, you will get similar values when you check in your trading portal. So there you will be having also the call and the put. Like the similar thing which I explained in the crude oil, the exact gold CE and PE will be there. Okay. So this is what we call as the commodity indices, basically in options trading. So hopefully you understand this bullion market, this is commodity markets, this how the call and the put works. Whenever you expect the market to go up, take a call. Whenever you expect the market to go down, buy the put. This I am talking about options buying. There is a concept of option selling as well, but we will talk later on what is option selling. So for this, for the time being, you understand options buying strategy. So these are what we call options buying strategy. So I'm just talking about options buying strategy. In the next class, we will study about options selling strategy. Okay. In our next class, we are going to teach about what is option selling. So for the time being, this is called as option buying. Today we focused on option buying. Okay. So this is options trading in India and US market, and once we have lot of things in place, right, we can go and study what you can say crypto indices in options, where you can trade Solana, Ethereum, Bitcoin, all those things later on, once we get idea about how to trade Bitcoin and all. So for the time being, we will focus on these major indices: crude oil, natural gas, copper, aluminum, nickel, gold, silver and zinc. I hope that is clear. So in the next class, we will study about option selling strategy. So for the timing, it is option buyer strategy, how buyers make money and how sellers also make money. That thing also we are going to study. So for the timing, you study about what is call, CE and PE, just a brief description. Thank you for watching. Please like, share and subscribe to my channel. Thank you. Okay, fine. Thank you.